Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe. Click the bell so you get a notification of when we release a new video. I'm sitting again today with Willie Pelser. Morning, Willie.
Robin, it looks like we think summer's here.
Yeah, it looks like we're going to have 31 degrees here in Howard today. So, yeah. So, Willie, if I go back a couple of years, everyone was very, very concerned about South Africa and the debt trap and government finances. And obviously that was echoed in the bond market. We went well north of 12% on the long yield of the bonds. Everything's changed, hasn't it? So why don't you give us an insight as to some of the things that are rolling out into government finances space?
Yes, Robin, as you say, things have changed. And I think sometimes we just have to stand back and realize that the economy engine and markets do turn, sometimes quick, but some perspectives take a while to sort of filter through. And I think the bond market is an excellent example. As you say, not long ago, maybe 2-3 years ago, when we looked at government finance and they released the budget, we were talking north of 80% debt to GDP, and economists like myself and others have said, we're going to face a debt trap, we're going to 100% debt to GDP, and things have changed. So what has changed? I think let's start with government itself, and specifically SOEs. We're not going to talk about Eskom again, but there was an issue with the Eskom's debt. We're going to take it into government finances, and that's the reason the bonds went up, because suddenly you're adding debt to the whole book. The Transnet saga, the Danel saga, the land bank, you name it. Yeah. And we all factored those things in. Then we had some form of solutions. We're using this net open forward position, some cash at the reserves that's been held at the Reserve Bank to sort out some of those debt that has come through. But I think from the underlying economy, that's really where things for government has changed. And we've seen it in the move in the bond market. As you say, we've come from substantially high levels, and every day the market is just ticking lower and lower. Why? First of all, the government finance. So, as I say, the net effect of those debt that's been sorted out, the fact that the economy is growing slightly, we're getting more government, corporate taxpayers in, we're getting consumers in, we've got this windfall. To some extent, we can call it the windfall from the two-pot system, because people are taking money out and the numbers are getting bigger and bigger as to how much people are going to take out. There is a tax associated with that. I can't take all my money. There's a tax portion. So that goes back into the fiscus. It brings down the overall debt situation. And I saw this morning that Mary Vilakazi, I think she's the new CEO, it's her first year as CEO of the First Rand Group. And she made the comment that government is now in a position that they can fund at lower levels, at lower interest rates. And that's the net effect of the bond market that's coming through. The bond market expression is twofold. Yes, why have we seen this? Government finances in a better position. The second thing is we all know interest rate cuts are coming.
Yes.
So we've spoken about this before, whether it's 100 or 200 points over the next cycle, the market is discounting that. Yes. And just to give you an example of how the market's actually thinking about government's finances, is every week government issue bonds. They put it out in auction. On average, historically, we would be 2 times, 3 times oversubscribed. The market, fund managers, pension funds, banks, and so on are looking for these instruments because they do liability managing, all sorts of things. And suddenly, like last week, we had on ultra long bonds 6 to 7 times oversubscribed.
Yeah.
So that means there's almost a shortage of government debt in the system because people are looking for those type of yields. So, a lot of positives coming through on the bond market specifically, which bodes well for everything, going into future, the equity market, etc.
So, Willie, let's maybe investors are not particularly aware, but when we start to talk the long bond of the market, the long end of the bond market, when that starts to get 6-7 times oversubscribed, what it's telling you is, because that's where the most pickup in capital can be if you're at that end of the market and buying there, investors are thinking that rates are even going lower than this, aren't they?
Correct. that's sort of the discount factor. Yes. So where are you going to get the most for your rand that you've purchased?
Yeah.
Is actually at the long end. It's the riskier asset, if we can put it that way. And yes, if you price for risk, which the market is selling, yes, we're happy with the risk. We're happy that South Africa's finances, they're in a good place, the economy is in a good place. And we're talking anything from 15, 20, 30 year. We even have a 50-year bond now.
Yes. Okay.
And that's where, the bulk of the activity is taking place. So it's a vote of confidence from the financial market, or the interest rate market, actually, that we can go lower than what we think.
Yes. Yeah. And it's the first place we're starting to see foreigners sniff a little bit, aren't we? They're coming in.
Yeah, it's a fairly liquid, all South African asset markets, whether it's the equity market, the currency market, or the bond market, it's fairly liquid. But South Africa is known for their liquidity in the bond market. And foreigners do like that because they're not tied in, if I can put it that way. If they want to move a bulk of investments in or out, there's a price mechanism that they can use. So the vote of confidence is there. They every day in the market, they're buying, they're net buyers at this point.
Well, that's great to hear. Willie, thanks for giving us that insight. Thank you for joining us. Please don't forget to like and subscribe, and we'll catch you next time. Bye-bye.